Have you noticed the stock market has been like a roller coaster the last month or two? It's been all over the board. There was a general downturn, and then several days where there were historic increases in the market, and then it turned south again. So one thing to keep in mind about the stock market is that it operates as much on psychology as anything else. Yes, there are technical and fundamental reasons for big increases and drops, but it is so often psychology that plays a big part. A lot of it too is the reporting that people get about the market, and that includes the financial media who may have their own interest in how they convey information about the markets. But consider back in early 2020, there were steps taken that increased the money supply and the printing of money. And what did we get from that? We got enormous inflation. The consumer price index went from under 2% in early 2020 to up to 9% the following year. And what did that do? That increased all the prices that you pay every day when you go to the grocery store or buy any of a number of different items that you need on a regular basis. And those prices mostly have not come down because inflation compounds. And so the actions that were taken in early 2020 caused everyone to pay higher prices. Did you see the media and the financial media screaming that we were in a economic crisis and that you should sell your stock holdings and everything? No, you didn't. But people's actual budgets and their outgoing liabilities every month increase more substantially at that time than we see with tariffs. As I said in the previous video, if you watched it, about the stock market, the best action anyone can take, unless they need their money right now or within a week or a month, the best action they can take is inaction. Don't do anything. Just, as you've probably heard the old saying about responding but not reacting, I would say if you don't need the money, don't react. Don't even respond, because all you need to do is turn a blind eye to what's going on in your portfolio, and over time, if you're in the stock market, you will be rewarded. One thing you have to understand is that any concept of market timing is not a realistic concept. Market timing doesn't work. I was offering clients a market timing fund back in the early 80s, and it was supposed to be based on 3 different very scientific methods to determine buying and selling within the fund. And as we learned over time, none of those methods really work. So if you think you can get in at the lows and out at the high points, forget it. It just doesn't work. Many financial planners will point out that what is more important to have success in the stock market is time in the market, not timing of the market. So if you can continuously deposit money in the stock market over the years, if you have a long time horizon, you're more likely to have success that way. For people who may have reacted to the big swings in the stock market recently and pulled money out as the market dropped or when it was at its low, they will have a hard time recouping. They have locked in losses. So that's my message to you as we go through the gyrations of the market. Don't react. And this is author K. Richard Douglas of the upcoming book, The Wise Guide to Wealth, which will be coming out by the end of 2025, that you can order through your favorite bookstore.